If you're always the one saying no, let's stop, let's think about it, it's not going to work very well. And you need to establish that reputation that you understand, who your client is in that setting, and that you're willing to make some compromise in order to help the business succeed.
This is a Security Weekly production. Security Weekly is a resource of Cyber Risk Alliance.
The Cybersecurity Collaborative is proud to present CISO Stories. Each week, CISO Stories takes a deep dive on security leadership with one of the contributors to my latest book, the best-selling CISO Compass: Navigating Cybersecurity Leadership Challenges with Insights from Pioneers, as well as other top CISOs and industry security leaders. The Cybersecurity Collaborative is a unique membership community enabling cybersecurity leaders to work together in a trusted environment. To learn more, visit securityweekly.com/CSC or visit cyberleadersunite.com. I'm your host, Todd Fitzgerald, and this week we welcome Paul Sand, VP, Director and Technology Risk Officer at FHL Bank Chicago.
My pivot into the security world was when I was working with some early stage startups. And the startup that I was working on, was headed in the wrong direction. So I was looking for my next opportunity and actually found some interesting technology that had been developed by the Illinois Institute of Technology related to voice over IP security, protecting the voice channel to essentially stop that from being a vector to exfiltrate data. And there was place in the market for that. There was a need in the market for that. And I was able to negotiate a license to commercialize that technology out of IIT. So I founded Solari Security that focused on doing that and spent a number of years, building relationships, working towards our first set of customers, which was, how I stepped into the security. Eventually, Solari Security didn't play out. The reason for that is after we had worked for about 2.5 years to get our initial orders with the United States government with one of those 3-letter agencies, sequestration hit, and they pulled back all of their purchase orders, and everybody I was working with was thrown to the wind. So had to make a decision about how long I could keep that concern running, and just didn't have the capital to push it through and go through another cycle to develop some sales channels. So that led me to search for a role, and that's how I wound up at the Federal Home Loan Bank of Chicago, initially being their independent security officer and growing through that role to now where I am their technology risk officer. And in that role, I play oversight, so I'm in the second line of defense, and I'm responsible for making sure that the physical security, personnel safety, information security, and just the technology is flexible, scalable, and functional in meeting the needs of the bank.
So you actually, if I understand it correctly, you hold 21 U.S. patents?
That is correct. So back in my early history, I worked for Bell Laboratories, Lucent Technologies, and AT&T. And it was through that experience that I was fortunate enough to have an organization that encouraged that. And I just wasn't all that smart. I just worked with a lot of smart people, and we collaborated together, and you were able to produce a number of patents.
Wow, very interesting. And I know the bank you're with right now is a $100 billion wholesale bank that helps other banks, lends money to other banks as well.
Yep, and we've been very busy the last week and a half or so making sure that people had the money that they needed to run their small and regional community banks.
Yeah, absolutely. So security is obviously very paramount where you are. So today we're going to talk about, I think, a topic that is it's fascinating to me because it's something that I don't think we do well is most CISOs in many organizations, and that's using data to estimate the financial implications of cyber risk. So why don't you take us through that? What do you mean by that?
Well, I guess what I mean by it is I'll first, I guess, jump into why did I jump into this endeavor in the first place. The reason was that when we had discussions in the boardroom, we were always losing the board members because, we're a bank and our board members are very focused on understanding the financial implications of things. Also very keyed in on reading headlines. So as we've seen over the last couple of weeks, headlines drive a lot of discussion and very often have great relevance to what's happening in the bank. They'd read stuff in the press around cybersecurity and they'd ask about it, right? And it wouldn't always have relevance. And it was very difficult to always get the discussion down to what are the financial implications? What could it mean for us? So part of it was just we weren't using the right language. The other part of it is because we're a bank, we use this 3 lines of defense model. And not surprisingly, the first, second, and third lines would come to the board with slightly different opinions and further confusing. So it's like, how do they know why we're disagreeing? What's the source of that disagreement? As well as, really what is it that you're saying? So we really had an important problem to solve. And this project actually addressed both of those issues. So by taking a data-driven approach, what I was able to do across the 3 lines is essentially get away from opinions and not have that dominate the discussion, but move it more towards facts and more towards assumptions that were driving the opinions. So that it was much clearer to the people we're presenting to on what was driving those differences of opinion so they could make their independent judgment about who they would believe more or less. Additionally, by using data behind things, we're able to wrap that into financial terms and estimate what some losses might be for the bank and what those ranges might be so that there's a better sense in the boardroom on what those elements are all about when we're discussing cyber risk. But in order to jump in and approach that, we had to establish a structure to organize the thinking and direct the discussion. So the first thing that we had to do is take a look at how we thought about things. And what we decided on was an approach to basically use scenarios in order to drive the discussion. So we looked for scenarios that were generic enough that they didn't fit a specific sequence of events, but were also cohesive enough that the risks and the countermeasures that would fall out of that were the same, so that we would
what would be an example of one of those scenarios?
A good example is we have a period of time in the bank where we believe we can successfully operate manually without our systems, and at the end of that period of time, we don't think we could do that. So one scenario would be, a destructive cyber attack that we could address within that time period. Another would be something that caused us to exceed that. Plus, we also included into that mix is not just the cyber things, but the non-cyber things. So what if there's a fire in a data center or a flood or something like that that might push us to operate without technology? And we included those in the scenario, again, to make it a little more general, because the impact of the business is exactly the same, regardless if it was a cyber or non-cyber cause.
Mm-hmm.
And after we identified those scenarios, then it was a hunt for the data that we could use to put in and understand what those scenarios would mean. And there we looked at a variety of sources. One is our own data, because we've got a enterprise risk management function, that looks at what we call operational events, which are things that don't go well that we want to study and look and see if there's something that we could improve. So it's a good base of data to use in order to inform some of the things that we've already experienced. We're also, one bank within a federal home loan banking system, and our regulator, requires us to share some degree of information around those operational events so that we don't all have to learn the same lesson, that we can take the lessons from other banks and utilize those. So we had another data set there to use as well. And then it's just, basically industry stuff. So, for example, the Verizon data breach report, which looks at, some reported data breaches and cyber intrusions. It's a good source of data as well. So after looking at, what we had to offer, we then decided that the approach had to account for the fact that some of the things that we're going to see were measures of inherent risk. So for example, if we're looking at natural disasters that disrupted banks, those are inherent risks. If we looked at successful cyber attacks, those are residual risks because those have gone through all of the usual enterprise controls that would be used in place. The reason that's important is when we start to estimate the risk in the bank's approach, that if we're looking at an inherent risk, we'll subtract what we view as the value of our risk mitigations. And really what we wanted to do is to get to an apples and apples comparison of the residual risk and use that when we had the discussion with the board. So we had to be careful to understand what the data was about so that when we reached the end in the residual risk that we had something that was defensible and reasonable.
And that makes a lot of sense because, if you've already made these investments and you have these controls in place, then in terms of the risk that you're facing, it really is that residual risk. And I don't think I've ever heard anybody look at it that way. We're always trying to put controls in to mitigate the latest threat, but it really does come down to what is that residual risk. That's the thing that we really have to worry about.
Right. Plus, we had to look at the data too and say, what biases were inside of that. Because, for example, the Verizon data breach report, well, it tells you a good deal of information about the cost of things when something bad happens. It may not be as good of an estimator of the likelihood that something will happen because reporting isn't required, right? They get the stuff that gets reported to insurers, reported to government agencies that require that, and people just voluntarily do that. So that is a data set that's underreported. And what we had to do is kind of take a look at that and estimate what the degree of underreporting would be in order to help us support some frequency type data out of the Verizon data breach report.
The article this podcast is based upon can be viewed in the best-selling cybersecurity leadership book, CISO Compass, Navigating Cybersecurity Leadership Challenges with Insights from Pioneers. What I like about the Verizon report is that they give you the mitigation, some ideas for mitigation if you have these types of breaches. And we've had Chris Novak on the CISO Stories podcast in the past, and Chris has been involved in the data breach Verizon report since its inception, and he gives a perspective on that too if people are interested in learning more about that report. But were there other data sources that are like industry sources that you found were really useful as well?
I also looked at the Hanuman report and decided not to use that as much as the Verizon data breach report. The reason is Hanuman takes more of a comprehensive view. So they look at what's the entire impact to the enterprise in face of a data breach. And Verizon was more focused on, what is the hard dollar cost if you face a data breach, and excluding all those business things. And what I really wanted to understand was the hard dollar cost and what that was looking like, because the nature of our business is different from many other enterprises. And I didn't want to have data that was influenced by that as much as the Ponemon report was. Mm-hmm. As Ponemon was estimating things 3-4 times greater in terms of impact than Verizon was. I thought it was easier for me to take the hard dollar cost and layer on what we found in the bank in terms of what our business impacts would be.
Sure. Did you find differences? So you're talking about those different levels of reporting. Did you find big differences between what your first level were capturing and what they thought the risk was, and what the other levels were assessing that same risk?
No big differences. So the differences were mainly, adjacent rating categories, and not things that were spread further apart. And also, what was very interesting is that when we looked at the things that we were advising the bank to do in order to manage risk, we all agreed on what those things were, and we all said those are absolutely necessary. But we just had this disagreement about what the residual risk was currently.
Mm-hmm. What were some of those things that you were agreeing on?
It was, dealing with, building out, stronger network segmentation, evolving our, identity and access management to, more modern approaches, those sorts of things. And often, the disagreement really came down to opinions about where the industry's good practice was today. So is IT working to keep up with the industry, or is IT trying to catch up with where the industry is at? And that's kind of where our disagreements were. That the audit and risk management functions were a little more skeptical that we were keeping up, and a lot of it was more catching up. But it was really a subtle difference.
Mm-hmm. Sure. So when you're presenting to the board, what language did you find really started to resonate as you're collecting all this information?
Well, it really came down to dollars and cents. So after we defined those scenarios, identified the data sources, then we had to start to do the analysis. And that involved, going across the business lines of the bank to really look at what the business impacts would be based on those scenarios. So for example, if there was an attack that caused a breach of customer data, what would that mean to us? Would people stop borrowing money from us? Would they demand a higher rate of return when they're investing money with us? And if they're, business partners with us, would they be requiring higher margins for that business lines? Would they restrict those business lines? Would that force us to go to more partners in order to support the business that we had? And what, does that mean in terms of financial terms? As well as, looking at our regulator to say, what are they going to do with us? Are they going to, sit next to us, every day for the next 3 years and consume a lot of resources? And what does that mean too? So we had to look at a lot of those different things and pull those together, which required, engaging a lot of people within our bank. And I estimate that I probably, interacted with about 10% of the bank in terms of getting to those numbers. And of course, it's hard to come up with a number. So the approach always was to come up with a range, trying to get a range where we had a 95% confidence that whatever happened would fall in there, and then really break that into a low, moderate, and a high, sort of part of those ranges. So that, again, we could say this scenario might land high This is what that range looks like. So we can add things up and at the end give a complete view of what the impact would be.
I really like what you're saying because it's focused on the business. All the things you just mentioned were very business-oriented outcomes, and none of it was talking about the controls that needed to be in place. So you've clearly mastered that language with the board.
Another important characteristic that arose here too is when we started to look at the data, often we're looking at things that are going to occur once in 20 years or something like that. And it's how do you treat the data that you collect? Because, for example, if you see 3 things that happened in the last 5 years, is that 3 things that happened in a 20-year period if you're trying to collect it for 20 years? Or if you saw 3 things that happened 15 years ago, you're going to feel differently about the 3 things that happened recently versus 15 years ago. So we worked hard to maintain what we call the recency bias in the data that we used, because we want to have it be more relevant to today, and make sure that we focus the attention to make sure that that carried through the analysis that we did. And then kind of to tie this off is, once we were satisfied that we understood what the impact would be to us, we didn't want to stop there, because we also wanted to look at what would the impact be to our customers as well, and make sure that we had that in mind as we thought through things as well. That it wouldn't be reasonable for us to say we'll stop here because we're okay, or if we went a little bit further, our customers would be better off as well. So there was that final piece of the analysis as well.
I really like the approach. I think this makes so much sense. And I think, for CISOs to be successful in the future, they're going to need to be able to get to that language that gets into the finance and, what are the impacts to those different, business processes that we have in our organizations. So Paul, this has been great talking with you. I think we could talk forever about this topic because I think it's just so important for CISOs. What advice would you give to emerging CISOs, current CISOs, experienced CISOs, as they're trying to really show value for their programs?
Well, I think it's to take the time to sit down with your business and really understand what the business is all about and what the drivers are for profitability and supporting and maintaining and growing the business. That when you make security decisions, there's always going to be a trade-off, and you need to have a good sense going into those discussions on whether or not the trade-off is going to be worth it, so that the places where you need to dig in your heels and push the business to justify things more, or just let them proceed forward. Because if you're always the one saying no, let's stop, let's think about it, it's not going to work very well. And you need to establish that reputation that you understand who your client is in that setting, and that you're willing to make some compromise in order to help the business succeed.
I think that's great advice. Well, thanks, Paul. Thanks for taking the time today to help out all of our CISOs.
You're quite welcome. It's my pleasure.
Thank you. Visit more CISO Stories podcasts on securityweekly.com, where you will find an index to prior episodes. The Cybersecurity Collaborative is a unique membership community enabling cybersecurity leaders to work together in a trusted environment. To learn more, visit securityweekly.com/CSC or visit cyberleadersunite.com.